Welcome to Minority Landlords Podcast, your manual to financial freedom. Are you looking to escape the 9-to-5 rat race? Do you want to earn passive income while building generational wealth for you and your family and don't know how to get started? Well, you're at the right place. Here at Minority Landlords, we're here to help educate minorities about real estate investing. And now your host, Pepe Amoti.
Hey everyone, it's your host Pepe with a new episode of Minority Landlords Podcast. I'm super psyched for this new episode because it's one of the areas that affect most people from either getting started or scaling their real estate business. There are many different ways to finance real estate deals. And as we know, financing real estate can be tricky sometimes. Hence why I always ask people to be proactive and be very engaged in this process. You'll need to really pay attention to the financing options that you have and see what's best for you and your current situation. Before, I've talked about FHA and whatnot, and in this episode I'll be discussing all the other ways, the different ways you can finance real estate deals. You'd be surprised, there's a lot of creative ways to finance a real estate deal. There's ways you can even buy a deal with 0% down payment. Yes, you heard that right. 0% down payment, or what's also known as seller financing. I'll go through 10 different ways to finance real estate deals. I keep getting asked about this, so here we are. After this episode, you should have an understanding of how real estate investors fund their deals. So I'll go ahead and list for you guys the 10 different things I will discuss here, and then we'll dive more deeper into them. Number one, all cash. You can buy all cash, obviously. Number two, FHA, I've talked about that several times. Number three, VA loans, I've talked about this several times. Number four, conventional mortgages, I've talked about this as well. There's also portfolio lending, there's seller financing, there's hard money lending and private money, there's commercial loans, there's home equity loans or home equity lines of credit, there's partnerships as well, and I'm sure there's other ways too, but these are 10 that I would like to focus on since they are the most used methods. So let's get started in breaking them down. Number one, cash. This is for folks that follow Dave Ramsey method, which I think, quite frankly, it's ridiculous because leverage should be your best friend. Real estate being an asset rather than a liability, obviously if you buy correctly. And here when we are talking about real estate, we are talking about buying real estate that will be producing you income, multi-families and whatnot. In these cases, I strongly believe there's no problem with using leverage to buy real estate. Leverage is basically free money being given to you, especially if you get it at a low rate, and keep an eye on your numbers to ensure that you are able to cash flow after all expenses are paid by the tenants. For those that do not believe in leverage, that's okay. You can buy in cash. For most people, it's very hard to scale when buying with cash unless you are Jeff Bezos or come from a super ultra wealthy family. Also, you might think buying with cash will help you pocket the majority of the rental income since you won't have to pay mortgages and interest. But guess what? In a long term, the return won't be as good enough compared to if you had used leverage. Look at Mark Zuckerberg. Most of you all know him, the founder and CEO of Facebook. He's a billionaire, multi-billionaire, and I remember in 2012 he was all over the news for refinancing his home mortgage at about 1% rate or something like that. You might ask yourself, why would a multi-billionaire have a mortgage? It's because when you can borrow at an interest rate that's below the rate of inflation, you're essentially borrowing money for free. That's free money. And in today's low rate, how about use that money you would use to buy straight out cash and use it to purchase more and several properties or make other investments that will give you better return? So yeah, leverage is king that even the ultra rich use daily to accelerate their wealth. So what are you worrying about? You should also leverage. Number two, FHA. I've talked about this a bazillion of times. FHA, which stands for Federal Housing Association, is an easy way to get started. I keep telling you folks, you only have to put 3.5% down payment to buy 1 to 4 units with very minimal credit score required as well. If all you first-time home buyers aren't utilizing this product, then you are missing out. Great financing means to start with. Take advantage of the low down payments and the better terms. Nothing beats that. And I keep telling you, that's the best way to get started, because the down payment again is smaller than the conventional mortgages and other means. You only need a FICO score of 580 plus and a 3.5% down payment. If your FICO score is 500 to 579, then you need to put a 10% down payment. So please get your credit up. If it's crazy low, pay a credit repair company to help you bring your credit up, because it will save you tons of money. The other FHA requirement is only 31% and 43%. This means the monthly housing payment should not exceed 31% of your gross monthly income, while the total debt burden should not exceed 43% of your monthly income. I've been asked if you can have more than one FHA loans, and the answer is it depends. You all keep asking me. I've gotten this question couple of times. They can only allow this in certain circumstances, such as a family size, or if you are getting it due to a job relocation in a completely different place, like let's say 100 miles away or more. Standard is one FHA loan at a time, but you can have multiple in your lifetime, but you need to refinance the existing FHA to a conventional mortgage, then get a new one with a good reasoning. You have to have a really good reasoning in order to have more than one FHA loan at a time. Also, just an FYI, you can only use FHA loan as an owner-occupied property, not as an investment property. But after a year, you can move out and leave it as an investment property. All right. So the third things I've talked about this as well, is VA loan. It's a great loan for service members and veterans. So VA loan does not have any credit requirement, but it depends on the lender you use. As always, you'll know the better your credit, the better the lending terms you'll have, right? The better lending terms will be. You'll also have to use it as a primary residence, just like FHA, and you can't use it to buy investment properties. So keep in mind, there's funding fees with VA loan. Usually if you are an active duty, it's like a 2.15% of the purchase price for your first VA loan and 3.3% for subsequent VA loans. It does not have PMI like FHA, which does have it. PMI basically just like a mortgage insurance. Usually it's like $200 you have to pay every month with your mortgage. It's also have a max of 1 to 4 units, just like FHA. So great deal. But of course, for our amazing veterans or service members, I personally think for what veterans do, for all those military folks out there, they should be able to even purchase investment homes with a VA loan. But sadly, I think even I would join the military because of that, if they made it that you can buy investment homes with VA loans. So yeah, you can only buy owner-occupied properties with VA loans, and you have to be in the military. All right. So the fourth one is conventional mortgages. Conventional mortgages, basically, they are the loans that are not guaranteed or insured by the federal government. Right? And most of them are mortgages that meet the requirement to be sold to Fannie Mae or Freddie Mac. Basically, what Freddie and Fannie Mae do as a government-sponsored enterprise is that they purchase the mortgage from lenders, then they sell them to investors. And conventional financing is a little bit harder. Just keep in mind, it's a little bit harder than that of FHA due to their high credit score requirements and a minimum of 620 credit score in order to obtain it. And also they have a debt income ratio of 50% or lower. So you have to check that with your lender as well. If it's a single family home, you only need to put down a down payment of 5%. There's a chance to put a 3% down payment if it's your first home, but it depends on several different factors. Typically, sure deal is 5% if you're not a first-time home buyer, or you're not using the Home Ready program or Home Possible, which is for low-income folks. And if it's multiple units, starting with a duplex, it's usually 15% down payment. If it's a triplex, it's 20% down payment, and so on. So make sure you check with your lender if you can qualify for Home Ready and Home Possible programs, because they can allow you to put in very low down payments based on your financial situation. The good thing about this is You can have up to 10 of these mortgages. You can have up to 10 different properties. Meaning that, let's say if you house hack a single family property every year, you can get up to 10 with having to put only 5% down payment. However, if you have multiple units, it can be higher. Just keep in mind, like I said, 15% for a duplex, and it goes up from there. If it's a second home, even if it's a single family, just keep in mind, you'll have to put down a 10% down payment. The other thing you have to keep in mind as well is if you put less than 20% down payment on these conventional products, you'll have to pay what's called private mortgage insurance, PMI. This basically protects the lender in case you default on the loan. I personally don't care about the PMI because they are not that substantial. They're just usually a couple $100 added to your mortgage every month. The other thing you have to keep in mind as well is there's a limit of the loan size with these conventional means. It usually changes every year or so. So check these guidelines or ask your loan officer. Last time I checked for 2021, the limit is $548,250. So another requirement also you have to keep in mind for financing is appraisal, just as an FYI. With these conventional mortgages, they require appraisal, and you'll see that a lot with even the other different financing methods. All right. So number 5 is portfolio lending. Some of you might not have heard of this, but some banks, especially credit unions, have the ability to lend from their own funds. So sometimes their loan terms can be pretty sweet actually, since it's for individual credit union or bank. Not a really common though. It's not a really common financing mean, but it does happen. You won't see it being advertised, but if you call the banks or credit unions, they can tell you if they do that, and most of them do. So just pick up that phone, look up the banks or credit unions in your area and ask them about portfolio lending, especially credit unions. A lot of times they have really great deals. So pick up the phone and call them. The other thing, seller financing. This is not too common also, but sometimes can happen. Instead of the bank or other lending institutions financing a property, an owner sometimes can finance it, and instead of paying the bank, you are paying the property owner a monthly payment or whatever you all agree upon. One thing though to keep in mind, and why it's very uncommon, is because in order for the owner to do owner financing, the home have to have been fully paid off and fully owned by the seller in order for the owner to do that, to avoid foreclosure on their property. This can be good for folks who don't qualify for traditional mortgages and those who want to skip the lengthy mortgage process. But like I said, finding owner finance deals is very hard, so don't have your hopes so high. But it's out there, and if you're a go-getter and willing to find those, you will. The other one I would like to discuss is hard money lenders. There's a bunch of them out there. This is a financing that's obtained from a private business or individual, basically. I'm not a fan of these, even though they are easy to obtain, but the interest rates are way higher than normal. Usually it's about 8 to 15% or even more. And the terms are very short. Usually they're due in 6 months to 3 years instead of the traditional mortgage, which is usually 30 years. And a lot of folks that use these, usually you hear flippers or those that have properties that need rehab. Also the loans, you have to keep in mind too, the loans have fees, and those fees are very, very higher than usual. And it's like I said, it's super easy to get these. Usually it just takes like few days because no income or credit verification a lot of time is needed. And a lot of time, but still the interest rate, the high fees, and a very short time period make it not good for those like me who are trying to buy turnkey properties for a long-term hold strategy. The other one, similar thing to hard money, but it's a little bit different, and it's a little bit of a better, in my opinion, is private money lenders. These are basically individuals, and they are not professionals. They're just individuals that are willing to fund deals for an agreed term. Lots of time, this is better because both you and the lender can negotiate the terms such as the length, interest rate, and whatnot that you guys agree upon. But before jumping into hard money and private lending, make sure you do your homework and research further and carefully, very, very carefully. Since this is not a traditional lending mechanism, you don't want to get screwed. So I would suggest for y'all to have a lawyer ready to look into the terms to ensure that you don't get screwed. All right. The eighth thing I'd like to discuss is commercial loans. This is for y'all that are trying to buy properties with over 4 units, like me who's doing syndications. You will likely have to take out commercial loan. This one, I have several of them. The interest rates are usually slightly higher and the fees are higher as well, and the terms are a little bit lower. But good thing about this one is they do not care a lot about your debt to income like other residential stuff do. And like we know in residential lending, DTI, the debt to income ratio, is highly valued. But in this case, they only look mainly at the income the property is producing and base their lending on that. So they will look at your income and other financial indicators, but they will mainly focus more on what the property itself is producing in order for them to have an idea of whether or not the income producing will be able to cover all the mortgages and the other expenses. So I personally really love commercial loans because of that, because sometimes as you have so many properties in your portfolio, sometimes your DTI can be a mess. So with them not caring about debt to income ratio, I think in spite of a little bit of a higher interest rates and whatnot, I think they're really great because as long as you make your numbers work for those, it should be fine. Number 9 is home equity loans and lines of credit, right? If you have an existing primary residence, let's say, or a rental property already, you can tap into that equity and get cash that can help you purchase another property. And banks offer several products, and my favorite one is the Heloc, which stands for Home Equity Line of Credit. This is an actual lump sum cash you take out of your home or your home's equity, and works somewhat like a credit card if you look at it. You can borrow money up to a certain credit limit set by the lender and then pay them back the borrowed amounts along with the interest. The interest, again, can be a little bit high, so just pay attention to that so you don't find yourself paying so much. And the lender typically uses your home as a guarantor or collateral that you'll pay back the money you borrow. Basically, they're saying we'll hold this if you don't pay it. So usually if you have an existing property, it's very easy to get cash through that. And it's easier to do it with owner-occupied primary residence, just so you know. You can do this with multi-family properties too, but the terms can be a little bit harder since the lenders see you more riskier than if you're just doing it with an owner-occupied property. Last but not least, it's partnerships. Partnership is another great way of financing real estate deals. You can use partners' money to fund the whole cost or just to assist with the down payment. And they usually would receive only a percentage of what the property generates and maybe some equity in the property, depending on what you all agree upon. It all depends on your signed agreement, but make sure to have a lawyer involved to draft this agreement to prevent the he says, she says. All right, and there you have it. 10 different ways to finance the deal. Most